First Solar, Inc., NASDAQ, FSLR, has seen a notable increase in institutional investment, with Wealth Enhancement Advisory Services LLC boosting its stake by 25.2% during the first quarter, according to its latest SEC filing. This move reflects a broader trend among hedge funds and institutional investors, who collectively own over 92% of the company's stock. The heightened interest in First Solar comes amid insider selling activities, with significant stock sales by insiders Michael Korolewski and Patrick James Buehler, amounting to over $2.2 million in the past 90 days. Despite increased institutional interest, First Solar's recent quarterly earnings report fell short of expectations, posting an EPS of $1.95 against a consensus estimate of $2.50. The company's revenue, however, grew by 6.4% year-over-year, reaching $844.57 million. Analysts remain optimistic, with a consensus rating of moderate buy and a price target of $228.69, suggesting confidence in First Solar's strategic position in the solar energy market. The company's strong market position is underpinned by its thin-film semiconductor technology, which offers a lower carbon alternative to traditional solar modules, aligning with the increasing global focus on sustainable energy solutions.
Revvity Inc., NYSE RVTY, has seen a significant increase in its stock holdings by Gamma Investing LLC, which boosted its position by 42.9% during the first quarter. As per their latest SEC filing, this move is part of a broader trend of hedge funds and institutional investors increasing their stakes in Revvity, with entities like AssetMark Inc., Optiver Holding BV, and Quarry LP also making substantial acquisitions. Currently, institutional investors and hedge funds own 86.65% of Revvity's stock, illustrating strong institutional confidence in the company's prospects. Despite this confidence, Revvity's stock has experienced recent fluctuations, with several analysts adjusting their price targets. Notably, J.P. Morgan Chase & Company, Robert W. Baird, and the Goldman Sachs Group have all reduced their target prices, reflecting a cautious outlook amid broader market volatility. However, the stock maintains a moderate buy consensus rating, supported by a strong quarterly performance where Revvity surpassed earnings expectations with an EPS of $1.01 against a consensus of 96 cents. This performance, coupled with a strategic focus on expanding its health sciences solutions globally, positions Revvity as a potentially attractive investment, albeit with some market reservations reflected in the adjusted price targets.
Wealth Enhancement Advisory Services LLC has increased its stake in Penumbra, Inc., NYSE PEN, by 4.4% in the first quarter, acquiring an additional 136 shares, bringing its total holdings to 3,251 shares valued at $869,000. This move is part of a broader trend among institutional investors, as hedge funds and other institutional entities currently own 88.88% of Penumbra's stock. The company, which specializes in medical devices, has shown robust financial performance, with its recent earnings report exceeding analyst expectations. Penumbra reported a quarterly earnings per share of 83 cents, surpassing the consensus estimate of 66 cents, and a revenue increase of 16.3% year-over-year to $324.14 million. Despite a slight decline of 0.5% in its stock price to $249.53, Penumbra's market capitalization stands at $9.66 billion. Analysts remain optimistic about the company's prospects, with several brokerages like Royal Bank of Canada and UBS Group raising their target prices to $330 and maintaining a buy rating. The company's strong financial metrics, including a low debt-to-equity ratio of 0.02 and a high current ratio of 6.30, reflect its solid financial health and operational efficiency. The positive analyst sentiment and significant institutional ownership underscore confidence in Penumbra's growth trajectory, potentially influencing upward pressure on its stock price in the medium term.
Wealth Enhancement Advisory Services LLC has reduced its stake in H&R Block, Inc., NYSE HRB by 25.3% during the first quarter. As per their latest 13F filing with the SEC, the firm now holds 15,950 shares valued at $876,000, indicating a strategic adjustment in their investment portfolio. This move is part of a broader trend among institutional investors, with entities like SBI Securities and Harbor Investments also modifying their positions in H&R Block. Institutional investors collectively own a substantial 90.14% of the company's stock, reflecting significant interest and influence in the company's market performance. H&R Block recently reported impressive quarterly earnings, with an EPS of $5.38, surpassing analysts' expectations of $5.12. The company's revenue for the quarter was $2.28 billion, slightly above the anticipated $2.25 billion. These results represent a 4.2% increase in revenue compared to the same period last year, showcasing steady growth. Despite a negative return on equity of 179.57%, the company maintains a strong net margin of 15.20%. H&R Block also declared a quarterly dividend of $0.375 per share, translating to an annualized yield of 2.68%, which may appeal to income-focused investors. Analysts have mixed ratings on H&R Block, with some upgrading the stock to a buy, while others remain neutral, reflecting differing views on its future performance amidst market conditions.
Equity Lifestyle Properties, Inc., NYSE ELS, a real estate investment trust, REIT, specializing in lifestyle-oriented properties, has seen a notable shift in institutional investment activity. Wealth Enhancement Advisory Services LLC reduced its stake in ELS by 5.6% during the first quarter, now holding shares valued at $873,000. This adjustment is part of a broader trend among institutional investors, with entities like Bessemer Group Inc. and UMB Bank N.A. significantly increasing their holdings, while others like SRS Capital Advisors Inc. have initiated new positions. Institutional investors currently own 97.21% of ELS stock, indicating strong institutional confidence despite recent volatility. Equity Lifestyle Properties recently reported its quarterly earnings, posting an earnings per share, EPS, of 83 cents, aligning with analyst expectations. The company achieved a net margin of 23.99% and a return on equity of 21.99%, although its revenue of $327.21 million fell short of the anticipated $391.34 million. The stock has experienced a minor decline, trading down 0.4% to $61.61. with analysts maintaining a moderate buy rating and a consensus price target of $73.90. Additionally, ELS declared a quarterly dividend of $0.515 per share, yielding 3.34% annually, which underscores its commitment to returning value to shareholders amidst fluctuating market conditions. The REIT sector, particularly lifestyle-oriented properties, continues to attract investor interest due to its stable income potential and growth prospects. Analysts remain optimistic about ELS's long-term performance, supported by its strategic focus on manufactured home and recreational vehicle communities. As the market navigates economic uncertainties, ELS's robust institutional backing and consistent dividend payouts may provide a cushion against broader market volatility, making it an attractive consideration for investors seeking both growth and income.
Wealth Enhancement Advisory Services LLC has invested approximately $897,000 in MSC Industrial Direct Company, Inc., NYSE MSM, acquiring 11,545 shares during the first quarter. This acquisition is part of a broader trend of increased interest from institutional investors and hedge funds, such as American Century Companies, Inc., First Trust Advisors LP, and Charles Schwab Investment Management, Inc., which collectively owns 79.26% of the company's stock. MSC Industrial Direct, a distributor of metalworking and maintenance, repair and operations, MRO products, has garnered a consensus moderate buy rating from analysts, with an average target price of $90.33. Analysts from Loop Capital, J.P. Morgan, Chase & Company, and Stephens have raised their price targets, indicating confidence in the company's growth prospects. In its recent earnings report, MSC Industrial Direct reported earnings per share (EPS) of $1.08, exceeding the consensus estimate of $1.03. Despite a minor year-over-year revenue decline of 0.8%, the company has a market capitalization of $4.99 billion, a low debt-to-equity ratio of 0.21, and a current ratio of 1.92, underscoring its robust financial health. The stock is trading near its 52-week high of $90.85, supported by a dividend yield of 3.80% and a dividend payout ratio of 89.71%, appealing to income-focused investors. The strategic focus on expanding market presence and enhancing shareholder value, coupled with continued investor interest, suggests a stable outlook for MSC Industrial Direct in the competitive industrial sector.
Ryan Specialty Holdings, Inc., NYSE Ryan, has recently seen increased interest from institutional investors, with Wealth Enhancement Advisory Services LLC raising its stake by 3.9% in the first quarter, now holding shares valued at approximately $902,000. This move is part of a broader trend, as other major investors like Mariner LLC and UMB Bank N.A. have also incrementally increased their holdings in the company. Despite this institutional backing, Ryan Specialty's stock has seen a recent decline, trading down 2.6% at $65.84, which is below its 52-week high of $77.16. The company's recent financial performance shows stability, with its quarterly earnings meeting analysts' expectations at 39 cents per share and a notable 25% increase in revenue compared to the previous year. However, the high price-to-earnings (PE) ratio of 193.65 and a significant debt-to-equity ratio of 3.45 might be contributing to investor caution. Analysts remain optimistic, with several upgrading their ratings and adjusting price targets upwards, reflecting confidence in the company's strategic positioning in the specialty insurance market. Despite a dividend yield of 0.73%, the payout ratio of 141.18% suggests that the company is returning a significant portion of its earnings to shareholders, which could impact reinvestment in growth initiatives. As the market evaluates these dynamics, Ryan Specialty's ability to maintain growth and manage its financial leverage will be key to its future performance.
Wealth Enhancement Advisory Services LLC has significantly reduced its stake in Crocs, Inc., NASDAQ Crocs, cutting its holdings by 77.7% in the first quarter. The advisory firm now owns 8,489 shares, valued at $901,000, after selling 29,574 shares. This move comes amid a period of mixed analyst ratings for Crocs, with Barclays lowering its target price and Goldman Sachs issuing a sell rating, while several other analysts maintain a buy stance. The stock's average rating remains moderate buy, with an average target price of $135.13, reflecting a generally positive outlook despite recent volatility. Crocs reported impressive quarterly earnings, with a net margin of 23.35% and a return on equity of 43.07%. The company exceeded earnings expectations, posting $3 per share compared to the anticipated $2.51, although its revenue saw a slight decline of 0.1% year-over-year. The stock has experienced fluctuations, trading between $86.11 and $151.13 over the past year, and currently sits at $106.74. The company's strong financial performance and strategic positioning in casual lifestyle footwear continue to attract investor interest, despite some recent insider selling and cautious analyst adjustments.
Plens GP Holdings, LP, NYSE PAGP, a key player in the midstream infrastructure sector, saw an increase in institutional investment during the first quarter, as Wealth Enhancement Advisory Services LLC boosted its stake by 15.3%, now holding shares valued at $959,000. This move is part of a broader trend where major institutional investors like Tortoise Capital Advisors and Vanguard Group also increased their holdings in Plens GP, reflecting continued confidence in the company's performance and potential. The firm operates primarily in the crude oil and natural gas liquids, NGLs sectors across the United States and Canada, which positions it strategically within the energy supply chain. Despite the positive sentiment from institutional investors, Wall Street analysts present mixed views on Plains GP's stock. Citigroup and Barclays have adjusted their price targets downward, citing a neutral and underweight rating respectively. Conversely, Morgan Stanley and J.P. Morgan Chase & Company have raised their price objectives, maintaining an equal weight and neutral stance, reflecting cautious optimism. The stock currently holds a consensus rating of hold, with an average price target of $20.88. Plains GP's financial metrics, such as a debt-to-equity ratio of 0.49 and a market cap of $3.86 billion, suggest a stable yet cautious outlook amid fluctuating market conditions. As the company navigates these dynamics, its performance will be closely monitored by investors seeking to capitalize on its strategic positioning in the energy sector.
Both Enhancement Advisory Services LLC significantly increased its stake in Sensata Technologies holding NYSE Street by 235.5% in the first quarter. As per its latest SEC filing, the firm now owns 37,395 shares valued at approximately $908,000. This move is part of a broader trend where institutional investors and hedge funds, which collectively own 99.42% of Sensata's stock, have been adjusting their positions. Notably, Sensata Technologies, a company specializing in sensors and sensor-rich solutions, reported a first-quarter EPS of 78 cents, surpassing the consensus estimate of 72 cents, although its revenue of $911.26 million marked a 9.5% decline year-over-year. In terms of market performance, Sensata's stock opened at $32.08, with a 52-week range between $17.32 and $42.33. The stock maintains a market cap of $4.69 billion, a P/E ratio of 39.61, and a dividend yield of 1.50%. Analysts have mixed views on the stock, with a consensus rating of hold and a target price of $34.42. Recent analyst activity includes UBS Group setting a buy rating despite lowering the price target to $30, while J.P. Morgan Chase & Company issued an underweight rating with a target of $21. The company's strategic moves, including a recent dividend declaration and insider buying activities, indicate ongoing investor interest amidst a challenging revenue environment.